everyone, and welcome to the Checkmate Real Estate Podcast, brought to you by CGE Studios, the multimedia company that encourages you to create, entice, and live nice. Sorry. And WPKN 89.5 FM radio. My name is David Smith, a.k.a. Smitty D.
And I'm Anthony Ramo.
It's your boy, Biz the Manager. You know we in the building, baby.
And today, we have a very special guest, a serial entrepreneur, real estate fund manager, and mentor, focused on building companies with values that not only provide great returns for investors, but also solid foundation for newcomers to grow in the commercial real estate market. Ladies and gentlemen, I present Mr. Eddie Austin.
The applause.
That's all I'm
goes wild.
Very nice intro. I'll try and live up to that.
So Eddie, thank you for joining us today and taking the time to educate us and our viewers. I just wanted to start off with a very simple question, and I think it'll segue nicely into the further questions that we have. So just briefly explain what inspired you to venture into commercial multifamily investing, and what has been one of the most rewarding parts of this journey for you?
Oh, man. I guess I'm going to set the stage by just being broke.
Can't we all relate?
Yeah. No, I entered this space simply because I've always been a visionary. I've always, been blessed to be able to look far forward and, put things down on paper. I'm a numbers guy. And, going as a W-2 job, I was skilled trades in a lot of different things and welding and mechanics. And you can kind of know what you're going to make from that. And I just wrote that down on paper. And then I wrote down living expenses and, put it all on a legal pad. And when I did that, I just kind of could see the future. And I'm like, oh man, it's not going to work. I'm not going to be able to retire the way I want to retire. So I had to explore other areas. Didn't know what that looked like at that time. But, as I got deeper and deeper, I started studying the wealthy. And from there, I derived it being in commercial real estate and anything that involved with real estate.
Did we lose you?
Are you still
You
there?
still there?
Oh, okay. All right.
There's a lag.
No, it's all good. It's just the way you stopped. It was real sudden. I was like, oh, did we lose him? Oh, no, what's going on? Dave, I think you had a question?
Yeah, no. I mean, but even just stemming off of that, like just understanding, hey, man, these W-2 jobs and the wages and even, my 401k plan and everything that I have situated out, like you lay it out as a game plan, and you're like, okay, this is just not enough. It is not enough for retirement. It is not enough for me to really live a life that's comfortable for me. What am I really going to do here? And that's the exact same type of question I had to ask myself a couple of years ago. And it's like, man, this is just not, working. So I completely feel you in that regard, where it's just like, hey, there has to be something bigger. There has to be something better. I had to expand my knowledge base. I had to expand what I want. So, and that's where I was really feeling,
No, understood.
Absolutely.
But,
For me,
I'm
sorry. For me, I just kind of looked at it as like, okay, well, what does these skilled trades make? And it was 6 figures a year. That was always striving to make that 6 figures a year. Yeah. And then you take after taxes, you're looking at, say it's $100,000 a year. Depending on where you are and what state you're in, $64,000 to $74,000 a year. That's what you have to work off. And from there, you can just break it down. What's your house payment? What's your car payment? How much you're going to save for retirement, and then just hit times 10. If you're going to work 10 years, hit times 20 for 20 years, just keep going. You'll figure out where you're going to be.
Absolutely. I feel like that's what a lot of people don't do. They don't write it out on a notepad. They say they think about it. They say they know their financial plan. They know how much they make. They know how much they spend. But they don't actually know until you write it down. You look at your bank statements and you say, hey, I actually spent $200 more on food and eating out than I thought I did.
Literally.
You don't realize how much that $200 eats into your savings plan, into your retirement.
Compounds.
Yeah, one thing I noticed, like speaking to my financial advisor, he actually had me like write it all out. And once I wrote it all out, I was like, oh, I can make so many different changes. Like, you know what I'm saying? And just like really visualizing is like, it's a part of like, like affirmations and things of that nature.
Visualization helps you conceptualize the actual like product.
Product, exactly, exactly.
There we go. So Eddie, back to my question that I had for you. When you come across a new multifamily investment opportunity, like what personal instincts or experiences guide your evaluation process?
Well, this might be a little bit different answer to that, but so when I have a property that's sent to me or in an area that I'm interested in, I look at the numbers, and the very first thing I fall in love with is the numbers. But the second deciding factor to whether I'm going to pursue this property or not is when I actually physically walk on that property and what kind of feeling I get from that. It has to feel like this is the property. Like I walk on this property, I'm like, this is it. I'm going to buy this property because I've already fell in love with the numbers.
Absolutely.
Love that.
It's something instinctual down inside of you that tells you it's a deal or not.
100%.
Absolutely. We actually went to go see 2 properties. Me and our business partner Harrison today, we went to go see some commercial properties, and we got that feeling right away that on the second property, this wasn't for us. We walked the first property, it was okay. You see some minor repairs that need to be done, some friendly tenants, etc. But then you get to the second property, and this was a complete mess. And you automatically can tell.
And there's some properties that that I knew the numbers were okay, but I could see the vision. Like when I got to that property, I could see the curb appeal. I seen something else that maybe somebody hasn't seen. And I was like, man, this right here, we could change the building color. We could add some things here, maybe build on a dog park there. And you can start to see that vision. You're probably the first one that's going to see that, but what kind of revenue that can be built from that's just not on paper yet.
Absolutely. There's a sense of creativity that comes with real estate that you don't really get in many other industries.
Yeah, and because you're actually just literally bringing that property to life. Like especially if it's a ran down property, you could really create your entire vision within that property. I think that's like just phenomenal when it comes to the real estate game. But just a question for you. Reflecting on the changes in the multifamily market, like what personal observations have you made? And like when it comes to those shifts, like how do you adapt?
That's a great question. And it's definitely relevant for the times. And I look at it from a business standpoint. I'm, heavy in business. I was more a serial entrepreneur than I was a real estate person, but I've always looked at real estate as it's a business. I own a $60 million company that's in another state. So I have employees, I have vendors. I have to understand that there's a rise in cost and everything's going to go up. Insurance, taxes, nothing's going to stay the same when it comes to that type of economy. So you kind of have to predict that. And then you have to be pretty good at just seeing the future. Like, what does it look like for tenants? You have to understand that tenants also have an economy they have to pay for too. So, their maybe auto insurance goes up, their cost of living goes up. So even though my expenses are going up, so does my tenants. So to maintain tenant retention, I have to write a business plan that can work for everyone.
Agreed.
You just
don't
can't
want to
be too
displace
aggressive.
too many people at once.
No, I mean, I've been involved with business deals where people want to go in and they just want to overprice the product out of this world. And before you know it, you don't have any more customers, which your customers are your tenants.
It's the truth.
And from that point, now you have an empty building that you still have to pay for.
Nobody wants that.
No customers,
Nobody
no
wants
tenants,
that.
but still all the expenses.
Yep.
No bueno.
So I wanted to touch on the fact that you said you've been a serial entrepreneur your whole life. So what were the first few businesses that you started when you started your career?
So the first thing was at 12 years old, I was actually in a welding shop with my brother-in-law, and I was government certified by 15. So my first trade was, welding, and I did welding projects on the side, did a little side job business, you might call it. From there, I began turning wrenches and mechanicking and got into racing and helping out my friends with race cars and building high performance diesel trucks. From there, it was a metal fabrication business, a diesel shop, a hot rod shop. and just kept going with that.
You said a hot rod shop. What's your favorite type of car then? I feel like you're a car guy now.
Oh, I'm a huge car guy. So for me, 35 Chevy, and that's actually a car that I grew up running around in with my dad going to church. And then my favorite car in my time probably a 65 Mustang Fastback.
Ooh.
Mustang
Oh,
fast.
wow.
Yeah.
So
60s,
speaking of
man.
Mustangs, our other business partner, Harrison, actually owns a Mustang. I mean, it's nothing compared to that, I wouldn't think, in my opinion. He might hate on me for saying this, but it's a 2011, Mustang V6. It's bright red, beautiful, fast. So I think that's awesome. And I had a Challenger when I was like 18, 19 years old. So we all love cars here, it seems.
Yeah, love muscle. Like I want a 69 Chevelle, like so badly.
Oh, yeah. Yeah, that's my wife's favorite. She loves the Chevelle. She wants a 70.
Oh, wow.
Beautiful.
Well, then now we have something when we come take a trip out to you. We can go hit the tracks then.
Absolutely.
Perfect. So I have another question for you, real estate related. So could you share a specific story about, a particularly tough deal and some lessons that it taught you?
Absolutely. Probably the toughest deal I've ever been involved in was a really aggressive underwriting and, not understanding that a market could soften, meaning that if you were pushing, 5% rent growth, that may not be attainable. And then the second thing is your exit cap rate, being pushed way too high. Or the second worst of that was in a deal that I was involved in where it was a super aggressive construction renovation program, and those renovated products were going to bring a premium, and they just simply pushed the market too high.
Understandable. So from those, what did those really teach you? Like you dealt with all those different scenarios and different hiccups. What would you say is like one takeaway from both of those?
The biggest takeaway is just don't be greedy. Don't, money can be made, but that doesn't mean that every deal needs to make $10 million. Do the community a good service. I feel like I'm a relationship person. I'm not a transactional person at all.
For sure.
I try my best to get away from transactions in my opinion. So I've kind of carried that through all of my business ventures. So if I was to sell you a coaching program, just the one lump sum, $100,000, and that's the only thing you bought from me. But if I sold you 100 coaching programs at $10,000 a piece, it's a lot more money.
Yeah.
Absolutely.
So nobody needs
money
to just
and
get
a lot
rich.
more trust.
Exactly.
Biggest thing for us right now is trust too, because obviously we're new to the commercial side of things. So we're still finding the realtors, the brokers that we can trust. Even with sellers, you have to be very on edge when you're dealing with them because they could be very untruthful and lie to you when it comes to their financials. So it's just about overall forming that bond and rapport and trust with them so that you could get the best for both of you, for both parties.
Absolutely. I totally agree with that.
Hey, Eddie, I got a question for you. I wanted you to speak on your portfolio for a second, actually. What markets are you invested in, and what size and class properties do you typically pursue?
Honestly, I like to pursue properties that's over, 200 units in size. You get up around 400 and 500 units in one portfolio. It's a different monster. The easiest one to pull levers on is, 130 unit portfolio. That's, it's easy, but it's harder to get professional management for that. So I like the 250, 300 unit size. I really like the Dallas, Houston market. Definitely Florida, but Dallas or Texas and Florida, they're just higher insurance.
Yep.
And then North Carolina, South Carolina are just a little bit softer market, better insurance, but it's a little bit softer market. But I don't know. I think definitely the Sun Belt for me. I like
For sure.
I like the Texas market, Florida market, North Carolina, South Carolina. Kind of stay away from Georgia at this time. but definitely looking more towards Tennessee.
Okay. Yeah, definitely. That's actually, so we are in similar markets. We look at Florida too. We're actually dealing with a couple things that we're in negotiation on right now. So, maybe when we take this a little further down the line, we can have a discussion about possible partnership with you if you're open to that.
Absolutely.
And it's funny you bring up Georgia, how you're not interested in it at the moment, because I just got a deal that came across my desk today. It was two different properties, 200 units, and then I think another one 134 or 35 units. The seller is it's a distressed situation and open to seller financing and everything. So we're definitely looking for some partners that are familiar with the South down there. So
Yeah, for sure. I mean, don't get me wrong. I've seen a lot of money made in Georgia, especially around the Atlanta submarket. But for me, it's just not my cup of tea. It's just
Absolutely.
not what I look for. I don't know the market as well, and I've just heard too many bad stories about it. But,
For sure.
to go a little deeper on the subject, going forward, Eddie Austin and what we're involved in and what we do and my partners, we're looking more towards other asset types as well, not just multifamily, but intermingling that into a fund.
Beautiful, like storage units and things of that nature, trailer parks, etc.
RV parks and raw land.
Okay.
Oh yeah, raw land's gonna be huge coming up.
Yeah.
Yeah.
Yeah,
There's a lot of potential with raw land.
Hey, Eddie, in your personal opinion, now, would you advise a new investor to go the route that you're going in, whether it's like 200 units up, or would you take a more conservative approach and maybe like 20 to 50 units? Where would you see the correct avenue for a new investor to go in?
That all depends on the person. It just depends on how thick the skin is and how hard you want to work.
Okay.
If you're a good person that's attractable to other people, as far as partnerships, go bigger. If you don't want to really put in the work, go smaller and find smaller partners, and find something that you could probably take down in your wheelhouse. And another thing to think about is how much capital you're going to have to raise, and if those partners have raised that amount of capital previously, because you got a different capital market today than we've ever seen.
Yep, I can agree with you on that. I mean, us being new to these larger deals, it's definitely been a lot harder for us to get capital together for certain deals. So now we're kind of more relying on our sponsors and those partnerships that we've formed to tackle these deals to help us raise that capital. So are you on the investor relations side of things for your team?
So I do operations. We just recently brought in someone to do the investor relations. Of course, I'm usually, either the face of the company or the second face of the company. So
Okay.
I'm usually the one at the conferences and stuff like that. So I'm usually the guy that's raising the capital, or the people we're partnered with are raising the capital and they know that we're partnered together.
Absolutely.
So I do a mix of a lot of things, but the biggest thing I'm focused on right now is asset management.
Okay. What would you say has been within this past year one of your biggest hurdles that you've had to face with asset management?
Definitely understanding the softening market, rent collections, and understanding occupancy and days to revenue.
Quick question, because I'm a little novice when it comes to the real estate game. When you say the softening of the market, for the people out there who are listening and watching who don't understand the rhetoric, can you explain that for us?
Absolutely. So when you're underwriting a property, you're involved in this property. You've wrote the business plan. You're going forward, and you probably underwrote these rents at 2.5-3% rent growth. So you bought the property, say it's $700 a door. You're going to renovate. You're going to raise them about to $150 a door. Or let's say, just go easy numbers. Let's say it's $700 a door, and you buy it, and you're going to raise the rent $300 a door after you renovate. So you're going to be $1,000 a door. Mm-hmm. So that's the business plan. That's going forward. And then you're going to do a 2.5 to 3% year over year on every renewal to just increase the rent. Mm-hmm. So a softening market looks like this. So for instance, you bought the property at $700 a door. you renovated units, and then you went to lease these units, and you just couldn't get traction at $1,000 a door. So maybe you had to rent them for $950, or you had to rent them with a special, meaning $300 off the first month rent. So that's a concession. That's money you're going to have to burn off somewhere.
Yeah.
So from there, when you have your renewal, maybe your renewal, you're going to be, $1,050 a month, or however much that is. And then you can't make that renewal. You ended up renting for $1,010. So you're not building your revenue every single month or every renewal.
Gotcha. Okay. Now I understand. Appreciate that.
So that's a softening market.